Can you imagine a commercial real estate market growing to a staggering $253 billion by 2033? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In today's segment, we're diving into a compelling report by the iMark Group, which highlights the projected growth of the India commercial real estate market. As of 2024, the market size stood at $49.8 billion, and it's expected to skyrocket to $253.32 billion by 2033. This growth represents a compound annual growth rate of 19.81% from the years 2025 to 2033. The report attributes this phenomenal expansion to several key factors. Intense urbanization, economic growth, and evolving corporate dynamics are driving demand, especially in technology hubs like Bengaluru, Hyderabad, and Pune. The IT and IT-enabled services sector remains a major player, continually seeking large-format, Grade-A office spaces to accommodate their growing teams and hybrid working models. Moreover, the rise of co-working spaces and managed office service providers is adding flexibility and efficiency for startups and small to medium enterprises, boosting occupancy rates in major cities. Government reforms, such as the Real Estate Regulatory Authority and Goods and Services Tax, have enhanced transparency and investor sentiment, making the commercial real estate sector more organized and reliable. In the retail sector, there's a revival as global brands increase their presence and e-commerce operators invest in high-grade warehousing and logistics parks. This warehousing and logistics subsector has become a pivotal driver, thanks to strong demand from third-party logistics and e-commerce players aiming to cut last-mile delivery times. The growth of organized retail, coupled with rising disposable incomes, is fueling the expansion of malls and shopping centers in Tier 1 and Tier 2 cities. Foreign direct investments and the introduction of real estate investment trusts are opening new financing avenues, encouraging developers to launch new commercial ventures. This synergy of digital adoption, infrastructure upgrades, and policy-level incentives is attracting both domestic and foreign investors, making the India commercial real estate market an exciting and upward-moving sector for long-term growth. Philadelphia's industrial market has been making significant strides, even amidst a noticeable slowdown in new construction starts. According to Commercial Edge data, the metro area saw steady development, with Hilco Redevelopment Partners securing a substantial $500 million loan from PCCP LLC for the redevelopment of the 15 million square foot mixed-use industrial park in South Philadelphia, known as the Bellwether District. In April, Philadelphia's industrial pipeline remained active, with nearly 6.2 million square feet of space delivered and more than 8.3 million square feet underway. However, the pace of new construction starts has slowed significantly, with only 1.2 million square feet breaking ground year-to-date through April, a sharp decline from the 4.5 million square feet recorded during the same period last year. Despite this slowdown in new starts, the sales volume of industrial assets in Philadelphia has seen an increase. Investors traded $193.2 million in industrial assets across the metro year-to-date through April, with a total of 23 properties totaling more than 2.2 million square feet changing hands. Interestingly, these properties sold for an average of $110 per square foot, which is below the national average of $131 per square foot. Philadelphia's industrial pipeline outpaced several peer markets, including Atlanta, Kansas City, and New Jersey, but it still lagged behind Phoenix, which remained well ahead. Major developments in Philadelphia include the Bellwether District, a $4 billion 1,300-acre industrial hub in South Philadelphia, and Portman Industrial's I-76 Trade Center's Building B, a 636,120 square foot cross-dock facility in Exton, Pennsylvania. In terms of industrial completions, Philadelphia delivered nearly 6.2 million square feet across 13 projects year-to-date through April, marking 1.3% of the market's total inventory, more than double the national average of 0.5%. Only Phoenix and Kansas City delivered more space during this period, while Indianapolis, Atlanta, and New Jersey trailed behind. Philadelphia's industrial vacancy rate reached 8.1% at the end of April, aligning closely with the national average of 8.2%. Compared to similar metro areas, Philadelphia's vacancy rate was in the middle of the pack, with Chicago, Indianapolis, and New Jersey reporting higher rates, while Kansas City posted the lowest vacancy rate at 5.1%. The Shops at Wissinoming, a prominent retail center in Northeast Philadelphia, is now up for sale. Originally built in 2018, this shopping center is currently 98% occupied, maintaining its original tenant lineup, which includes the well-known supermarket chain, ShopRite. The center's anchor, ShopRite, is a significant draw for consumers, contributing to the center's high occupancy rate. In today's retail real estate market, grocery-anchored centers like the Shops at Wissinoming are highly sought after by investors. These types of centers are often considered stable investments due to the consistent foot traffic generated by grocery stores, which serve as key tenants. The presence of Wawa, a popular convenience store chain, further enhances the center's appeal to potential buyers. This sale comes amid a broader trend in the retail real estate sector, where grocery-anchored shopping centers are being viewed as the darlings of real estate investors. This trend is evident in other recent transactions, such as the sale of a giant-anchored suburban Philadelphia shopping center for $27 million and a South Jersey shopping center that sold for 44% more than its 2022 price. In Kitchener-Waterloo, Ontario, similar trends are observed where retail spaces with strong anchor tenants are in demand. These spaces often serve as community hubs, attracting steady consumer traffic and offering long-term investment stability. Comparing this to the American market, particularly in places like Philadelphia, we see a cross-border relevance where the appeal of grocery-anchored centers remains strong on both sides of the border. As the commercial real estate landscape continues to evolve, both investors and developers are keeping a keen eye on these grocery-anchored properties. They offer not only a stable income stream, but also the potential for appreciation as consumer preferences and urban development patterns shift over time. In recent developments, a large office building in Dayton, Ohio, has been sold for $5.5 million United States dollars, as reported by Lauren Steen in the Dayton Business Journal. The transaction involves a substantial property located in Washington Township. This sale adds to the dynamic commercial real estate activity in the region, reflecting ongoing interest and investment in office spaces. The Dayton office market has been experiencing significant transactions, with this latest sale further highlighting the area's appeal to investors. The building's sale price indicates a robust demand for office properties, despite broader economic challenges that have impacted the commercial real estate sector nationally. This transaction is part of a broader trend where investors are actively seeking opportunities in secondary markets like Dayton, which offer attractive returns compared to more saturated primary markets. This aligns with a pattern observed in other parts of the United States, where secondary cities are becoming increasingly popular due to their potential for growth and development. In comparison, the Kitchener-Waterloo region in Ontario is also seeing increased activity in its office real estate market. Similar to Dayton, there is a growing interest from investors looking to capitalize on the region's economic potential. The influx of technology firms and startups in Kitchener-Waterloo is driving demand for office spaces, mirroring the trends observed in Dayton. The cross-border relevance is evident as both Canadian and American markets show a preference for investing in office properties in emerging regions. These areas are poised for economic growth, offering investors a chance to diversify their portfolios and achieve substantial returns. As such, the sale of the Dayton office building is a testament to the enduring appeal of strategic investments in promising markets. The Dodge Momentum Index, a key indicator from Dodge Construction Network, showed a growth of 3.7% in May, reaching 211.2, up from a revised April reading of 203.5. This index, a predictor of non-residential building projects, highlights a steady increase in planning activity, particularly in the institutional sector, which saw a 10.5% rise. Meanwhile, commercial planning grew modestly by 0.8%. Sarah Martin, Associate Director of Forecasting at Dodge Construction Network, noted that non-residential planning continued to accelerate due to strong project activity on the institutional side. She pointed out that commercial planning momentum also improved, despite previous months of subdued growth, particularly outside of data centers. In the commercial segment, Accelerated planning for warehouses and hotels drove the index, while office and retail planning remained flat. On the institutional side, a notable increase in education and recreational projects contributed to the gains, even as healthcare planning experienced a mild slowdown. The overall index was up 24% compared to the same month last year, with commercial planning up 15% and institutional planning up 47%. Excluding data center projects, the commercial portion of the index would have seen a 5% increase, and the entire index would have grown by 7% over the month. The Dodge Momentum Index is a monthly measure of the value of non-residential building projects entering the planning phase, often predicting construction spending for these buildings by a full year. This index suggests a potential pickup in mid-2025, although economic and policy uncertainties might impact these projects. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.